So this morning we're going to be talking about claims against directors, and it's really going to be a bit of a compare and contrast talk in which I'm going to be looking at misfeasance as an alternative, particularly to thinking about wrongful trading claims against directors, but also thinking as well about misfeasance under the Companies Act as a possible alternative to claims for transactions at an undervalue or for preferences. So this is really what we're going to be looking at, what the problems are with wrongful trading, and a quick refresher on what you need to prove to bring a wrongful trading claim. And we're also going to be looking at Companies Act misfeasance claims, what you need to prove, whether that's better. I'm going to say a little bit about Section 212, which is the summary remedy for misfeasance, as I think that is often misunderstood. And I'm going to be looking at other uses for misfeasance claims as being possibly other ways of formulating transactions at an undervalue claims and claims for preferences. And finally, I'm going to circle back to wrongful trading again to look at the connection between disqualification orders and wrongful trading. So just as a reminder, there are three elements that you need to prove as liquidator or administrator, of course, as the claim is very similar if brought by an administrator. Three things that you must prove to succeed in a wrongful trading claim. First one is a tipping point. The second one is lack of skill and knowledge by a director. And the third one is financial loss. The first of those, the tipping point, you have to show that the director should have known at a particular moment in time that from that moment the company was not going to avoid an insolvent liquidation or administration. For the second of those points, the lack of skill and knowledge, you have to show that a reasonable director with all of the skill, knowledge and experience of the director in front of you, that reasonable director should have realized that the company was about to go over the tipping point. And the third thing you have to prove, financial loss, is you have to say what it is, you have to prove what it is that a reasonable director would have done differently or sooner, and how that would have softened the damage. Now, the director can defend a wrongful trading claim, even if you can prove those three elements, if they can prove that they did all that they could to minimize the creditor's losses. Now, I think that if you can prove your point on financial loss, it'll be incredibly hard for a director to prove that they have actually done all that they could. And of course, at the moment, there is a temporary relaxation of the wrongful trading regime. In fact, more accurate to say that the wrongful trading regime has been relaxed twice. The first relaxation was a response to the first lockdown, and it was backdated to the 1st of March last year. It lasted for 6 months, ending on the 30th of September. There was then a gap during which wrongful trading was back with full force, and then it was relaxed again from the 26th of November. And that second relaxation is due to end on the 30th of April. But the legislation that relaxes it is flexible, so it may end sooner or it may last for longer, depending upon the circumstances. And just to make things even more complicated, the law is now in 3 places. So you've got the law on wrongful trading itself in the Insolvency Act. You've got wrongful trading relaxation 1 in Section 12 of CIGAR, the Corporate Insolvency and the Governance Act. And you've got the current relaxation, relaxation 2, is in Regulation 2 of, take a deep breath, the Corporate Insolvency and Governance Act 2020, open brackets, coronavirus, close brackets, open brackets, suspension of liability for wrongful trading and extension of the relevant period, close brackets, regulations 2020, known as cigar slaughter to its friends, I think. So the temporary relaxation just means that you cannot prove during the temporary relaxation period, during either of those temporary relaxation periods, that the director in front of you had any responsibility for the deterioration of the company's financial position that occurred during that time. Now, it applies only to claims that are being brought for wrongful trading under the Insolvency Act. It does not apply to claims that are being brought under other pieces of legislation. And it does not apply if the company was a financial services business, and you'll need to look at the list in Schedule ZA1 of the Insolvency Act for the list of financial services businesses for that. Now, the practical effect of this is that wrongful trading as a claim against directors is, for the foreseeable future, completely knackered. Because it is just one further complication to add to the mix that is going to make it really difficult to bring a wrongful trading claim if you're looking at any period during which the wrongful trading regime was relaxed. Now, I think you might be all right if the tipping point is clearly later than April 2021 or whatever date may finally be substituted for that. But I think for now, wrongful trading is really going to be very, very difficult to use. Even without that, we have got other problems with wrongful trading. And without wading deeply into the decided cases about them, I've got these summaries here. One is really the problem of proving the trigger date. And there are three things you need to prove for the trigger date. The first is you need evidence of what the company's financial condition was on any given date. The second one is you need to be able to prove that that particular financial condition meant that insolvency was inevitable, which is a degree of analysis from the proof that you've already got of insolvency. And then there's a further degree of analysis that you need for that to show that a particular director should have realized that they were at the trigger date. And the problem there is that if you have expert forensic evidence on those 3 points, it quickly becomes very, very complicated. And the danger is that the director will just say, well, if you actually needed an accountant with that degree of specialization to say that my company was at an end, how was I supposed to have known that? And of course, if you don't have the expert evidence, you probably haven't got enough evidence to bring the case. And of course, the further complication is that you, as the liquidator, cannot bring that expert evidence yourself because the expert is supposed to be independent and impartial. And you, of course, are a party to the claim, so you cannot be your own expert. And even if you've got expert forensic evidence, you need to brief the expert really clearly so that they give evidence on those 3 points of proof. Otherwise, you end up with confusion about what evidence is being put in as evidence of the trigger date and what evidence is being put in as evidence of financial loss caused by the wrongful trading. So with all of those complications, it might be a really good time to start thinking about misfeasance as an alternative way of bringing a claim against a director for what is effectively wrongful trading, trading whilst insolvent when it was not reasonable to do so. And the Companies Act contains some useful statements of what the main duties are on directors. And these duties apply equally to shadow directors and to directors who have not been registered at Companies House, but who are in actual fact the directors. And broadly speaking, directors are under a duty to keep within the constitution of the company. The important one, from our point of view, is they have a duty to promote the success of the company for its members or creditors. They also have duties to use independent judgment, to use reasonable skill, care, and diligence, to manage conflicts of interest, and not to be corrupt. So let's look at the second of those in a bit more detail the duty to act in good faith to promote the success of the company. That's pretty broad, but it is really measured by financial success if the company is solvent to the benefit of its members, or if the company is not solvent to the benefit of creditors. The nice thing about this is that the duty fundamentally does not change whether the company is solvent or not. It's still pretty much the same. Promoting the success of the company is very much about getting the best financial result that is reasonably achievable in the circumstances. So if you're looking at a fairly typical sort of case where you've got a balance sheet, the last one that you can depend upon was put together nearly 2 years before the liquidation, and it was approved a year before the liquidation, but it showed that the company was then upside down. And your deficiency account shows that there were further trading losses from the balance sheet date to when the company went into liquidation. Now, if you're bringing a misfeasance claim, you don't have to prove that liquidation was actually inevitable at any point on the decline curve, but you can simply say to the director, look, the company had negative net worth nearly 2 years before the liquidation started. You certainly knew that when you approved that a year ago. What decisions did you make from that date in good faith to promote the success of the company? Explain what you were doing. And as I say, it will be the same duty that is owed by the director to the company, whether it's the members, the shareholders, or the creditors who are losing their money as a result of their mismanagement. Turning back briefly to the suspension of wrongful trading, what effect does that have on bringing a misfeasance claim under the Companies Act? Absolutely none. It applies only to the statutory wrongful trading claim. So this is a case where if the director is saying, well, it was coronavirus, wasn't it? You can ask them to actually explain why it was coronavirus, wasn't it? I want to turn now briefly to section 212 and the summary remedy for misfeasance, because, as I say, that's often misunderstood. It's not actually defining misfeasance or setting out the basis for a misfeasance claim. It's just giving you, as liquidator or administrator, a route into court. It's giving you the right to use the Insolvency Act summary procedure, which is essentially regarded as being a satellite application under main insolvency proceedings rather than a standalone proceeding. In old money, the standalone proceedings are the ones that you would have started with a writ. Nowadays, it's a claim form. But it's just a case of being able to use a procedure which, in the right cases, is quicker and cheaper than the procedure that you would have to use outside of insolvency. Now, there's a whole new discussion topic on the fact that the courts are becoming concerned that the summary procedure is itself being used in cases for which it's not suitable. And that's something that particularly insolvency lawyers need to be aware of and alert to, but I won't go off in that direction this morning. Key thing about section 212, as I say, is it is procedural. It does not define any form of misfeasance. It uses the word misfeasance, which really just means wrongdoing, really, and it's not as serious as malfeasance, which would be evil doing. And misfeasance is really then just the hook that then pulls in the statutory examples of directors' duties under sections 171 to 177 of the Companies Act, including the one under section 172 that we've just been looking at. Let's have a quick look at the other Insolvency Act old favourites, transactions at an undervalue and preferences. We'll start with transactions at an undervalue. Now, what you would need to prove here to bring the claim under the Insolvency Act definition is a financially disadvantageous transaction. You have to show the loss of value to the company, that it didn't get in return for the transaction, it didn't get anything like as much value as it lost. The second thing is you have to show that at the time the company was then technically insolvent, either on a balance sheet or a cash flow basis. Now, there is a connected party presumption. If the asset went to a mate of the directors, then you can assume that the company was technically insolvent, but you really do need evidence to support that, because otherwise the director will deny that the company was insolvent, bung some flimsy evidence in your direction, and unless you've got something with which to refute it, you've then got a problem. And the transaction has to have been relatively recent before the company went insolvent, so in the last couple of years before you were appointed. Now, again, we'd be looking at section 172 as the Companies Act alternative to bringing a claim for a transaction at an undervalue. This duty for the director to act in good faith to promote the success of the company. So the elements that we've got here, firstly, if we've got a financially disadvantageous transaction, if you've got the director's Range Rover being sold for book value, which was about half what its trade value actually was, then yes, you've got the financially disadvantageous transaction, and that's unlikely to promote the success of the company. If you're bringing the claim under Section 172 of the Companies Act, you don't need to worry about the solvency of the company. It is simply a breach of director's duties for the director to sell the company's property for very much less than it is worth, unless there's a good reason for doing so in good faith. And the company is entitled to be compensated if the director breaches his duty of good faith, regardless as to whether it's the directors or the regardless as to whether it's the shareholders or the creditors who suffer. And you don't have the 2-year time limit. You can look back at transactions that happened further back in history than 2 years, but you do need to watch for the limitation period, because you will have to bring the claim within 6 years of the transaction having taken place. So you may run into limitation periods a little bit sooner with a Companies Act claim than you might with an Insolvency Act claim. And this is a nice one here. The director can be personally liable for the misfeasance. It is the director's wrongdoing. So if that patent disappeared for £100 to an offshore company, and it's hard to track what has actually happened to it, but somehow or other the director still seems to be benefiting from it, you don't need to try and uncover the chain of transactions or work out who owns the offshore company. Just the fact that the patent was sold for far less than it's worth is enough to be able to assert personal liability against the director and to try and recover the loss from him personally. Let's have a look at preferences, again in the context of Companies Act misfeasance. A reminder here again of the key elements to preference claims. They're very, very British claims. They're all about queue jumping. The idea behind them is that it is wrong to let a mate in to the front of the queue while everybody else is waiting patiently in line, and particularly in circumstances where the director's mate suffers considerably less when the company goes bust. Second point that you have to prove for the Insolvency Act claim is, in effect, bad faith. You have to show that the reason for allowing the queue jumping was that the director was influenced by a desire to see their mate doing better on the insolvency. They actually have to prove that they were acting in good faith when there is an obvious connection between them and the queue jumper. You also have to show that the company was technically insolvent. That's the same test as for a transaction at an undervalue. And again, if it's a connected party, it's easier, but you still need evidence. And you, again, have to show that this was within a recent period of time before the company became insolvent. 6 months if it's a party who is not connected. And those claims, of course, are very rare, but 2 years if it's a connected party claim. And again, we'll be looking at section 172, the duty on a director to act in good faith to promote the success of the company for the benefit of members or for creditors. And here, if you've got queue jumping for no good reason, you're entitled to ask why the director did it, and you're entitled to ask why it was done to promote the success of the company. But you've got no presumption of bad faith, so you would actually have to prove that this was not a good faith transaction, and that will depend upon the director's explanations for it, the strength of the connection, and what has happened to the asset and the business since. The solvency of the company is not directly relevant here, so you don't actually have to prove insolvency. But, of course, there's only a queue of creditors that's worth jumping if the company is insolvent. So in that sense, you are likely to have to prove insolvency. And again, the time period is irrelevant, but you have a general 6-year limitation period. Once again, one of the advantages of bringing a preference claim as Companies Act misfeasance is that it is a claim against the director personally, so you can bring a preference claim against whoever it is that got the asset and benefited from it, and at the same time you can bring a misfeasance claim against the director personally for compensation for the loss that the company has suffered as a result. In any claim for misfeasance, and this probably also includes Insolvency Act claims as well, including wrongful trading, transaction certain undervalue and preferences, the court can mitigate the damages that the director has to pay if the director can prove that they were honest, they were reasonable, and in the circumstances it is fair to let them off having to pay compensation for the full amount. You will always get directors and their lawyers throwing section 1157 back at you, but they do actually have quite a lot to prove in terms of being honest and reasonable, and where you've already proven a breach of a duty of good faith against them, that sort of tends to indicate that they've not been honest to start with. Final thing is, I said I wanted to circle back to wrongful trading claims under the Insolvency Act and look at the link between that and disqualification orders. And this is section 10 of the Company Directors Disqualification Act. And I have to confess, I tend to forget about section 10, but it's actually really useful. And what it says is that if you win a wrongful trading claim against a director or a fraudulent trading claim against a director, then the court has an automatic right to disqualify the director as part of the order that it makes, and the disqualification can be for up to the full term of 15 years. And you don't even have to ask for it. It's something that the court is entitled to do, even though it's not in the court papers in front of it for the decision it has to make. So what I would say to you as liquidators and administrators, if you're trying to run a rogue down for wrongful trading, why not mention that they could be disqualified under section 10 if you win against them, even if you don't ask for it. It's one of those delightful, useful things to negotiate with, because it really doesn't have a huge amount of value for you, but getting rid of a potential disqualification claim does have value for a director. So in terms of negotiating an out-of-court settlement, it's worth mentioning as you're approaching towards the settlement that, of course, if we do a settlement, then there won't be any risk of the court making a section 10 disqualification order against the director. So on that basis, would the director like to bung another 20,000 onto the table just to make sure that this is the sort of offer that the liquidator can certainly accept? So here we go. We've got to the point where I can show you the summary slide. And as I said, this is really a compare and contrast presentation. I think there are real advantages in bringing a misfeasance claim over a wrongful trading claim, just in that I think it is probably rather easier to prove. For undervalue transactions and preferences, it's a bit more nuanced, but the advantage there of using Companies Act misfeasance is that you can go after the director personally. So it's not a case of looking for restitution by trying to get the asset back from whoever has now got it. You can go after the director for compensation for loss suffered by the company. And of course, there's no reason to think about them as alternatives. I think it makes perfect sense to think about Section 172, breach of duty, as being something that you add to the letter where you're asking the director to explain exactly what has been going on. So I think we are now just about at the half-hour mark. So I've come to the end of what I wanted to say. If you've got any questions, please do ask them now. But otherwise, I will say thank you very much and goodbye. And I hope to see you next month when we're talking about insolvent charities. Now, I can see that there is a comment. Let me just see if I can get that up. I've lost my cursor. Here it is. It's just a thank you. So thank you all very much, and I will say goodbye. Thank you and goodbye.